This is possibly the most important reading, probably the most important reading of the behavioural finance section. The examiner over the years in the morning paper has been very interested in the behavioural biases of individuals. These are a list of biases that individuals can exhibit, and it's a very common exam question to have an individual in front of you that has made a comment or is engaging in some sort of behaviour, and you have to decide which bias it's most likely to be and potentially how they're going to act given that they are subject to that bias. So make sure you can diagnose these biases. You can see symptoms of people exhibiting these biases, and make sure you know what the impact on their behaviour is likely to be, and what the behaviour on the portfolio is likely to be. So very important reading, this one. We're going to go through 15 biases that individuals could have. 9 of them are cognitive and 6 of them are emotional. So we've already said in reading 7 that cognitive errors are issues to do with processing information, whereas emotional biases is more to do with feeling, all right? More to do with your kind of gut feel, how you're hardwired as an individual to respond to triggers around you. Cognitive is more about thinking, all right? Emotional biases are more to do with feeling. Now here's a big picture thing that I should put in place for you right now. It often comes up in the exam as well. Cognitive errors, they're actually easier to mitigate, to remove, to moderate, as it's sometimes referred to. Moderate. They're actually easier to moderate, in other words, remove through education. Okay, remove through education. That's easier, if you had a client with a cognitive bias in front of you, you've got chances that you could sit down and talk to them about the issues that they have with the way that they process information, the way that they think about the world, and the chances are you might be able to remove this bias from the asset allocation process. Emotional biases probably haven't got quite so much chance to change these emotional biases because they are just how the person is wired. Even the person themselves will say, you're just a hothead, me, or, well, I don't like taking risk, I'm scared of this. And they will know that, if you like, it's slightly irrational to be like that, but they will say, that's just me. There'll be no attempt to take responsibility for it. There'll be no attempt to change it. It's me, right? So, these emotional biases, if you've got a client sitting in front of you that is exhibiting a lot of emotional biases, you're not going to try and remove them. You're not going to try and educate them. What you're going to do is you're going to adapt the asset allocation of your portfolio to accommodate the the impact of the bias. Okay. Now, some examples of cognitive errors. We know that faulty thinking, faulty reasoning, shortcuts. We met heuristics in the last module. Shortcuts that lead to erroneous conclusions. Editing out information. Faulty selective or faulty memory. And this doesn't have to be going on in the conscious brain. Indeed, it would be slightly curious, wouldn't it, if you deliberately thought in a way which led you to make mistakes. This is often subconscious, or it's just related to how you have learned how to do something. Some past education has, taught you a way of thinking about something which actually doesn't reflect the world. And there's also just straight up errors made when processing correct information, just straight up mistakes. Think, Bayes' theorem, using Bayes' theorem, things like that. We don't often we don't process information perfectly correctly. The emotional biases, well, these are more about feelings, emotions. The motivations are more to do with maybe social factors, how an investor perceives themselves to look. Often these motivations are hardwired into their psyche. They're looking to seek the euphoria of pleasure, avoid pain. We saw loss aversion last time, where the pain of losing is greater than the joy of winning. And often this is quite impulsive. So these are they're not responses, these emotional biases, they're reactions. They're hardwired emotional reactions, which are really part of the character of the individual, and that's why it's hard to remove them. Now, I know you might be sitting there thinking, well, there's 15 in total here, 9 of these, and 6 of those. And, you know, it's going to be a long schlep, if you like. It's going to be a long slog to learn all of these, learn which ones are which. My advice to you is this: learn the emotional ones, all right? There's a little acronym here you can use called losers, all right? You know, the emotional ones, losers gives you the it gives you the heading to remember them. But I'll just state that now. We'll do the emotional ones actually in module 2 of this reading, and I'll come back to that acronym or the mnemonic to help you remember it. You can remember the emotional ones, all right, and then everything else must be cognitive. So don't bother trying to learn the 9 cognitive ones. Learn the smaller list, the losers, LOS-ERS, as we'll see in the next module, and the rest must be cognitive. And it is the cognitive ones that we're going to be focusing on today. Okay? Now look, we're introducing these behavioural traits like they are, you know, some sort of setting that a person can have. Of course, you have to bear in mind that, you know, people exhibit a broad range of different characteristics, and that these, you know, these behavioural traits can be exhibited very strongly, or maybe, you know, in a moderate way. One of the things that delegates do tend to feed back to us is that these behavioural finance traits seem to overlap, or they seem to be the same thing, or they seem to contradict each other. Now, I can understand why people would say that, but I don't think it's true. The result of these behavioural traits can cause individuals to behave in the same way. All right, so, you know, there might be one that's linked to laziness, which would lead you to not do anything. There's also another one that might be linked to the fear of something going wrong, which would lead you to never do anything, never take any risk. So, whilst these different traits can lead to the same behaviour, the processing, which is what the trait is, the processing, the reason why the individual thinks or feels that way is not the same. And one thing I do want to say at this stage is that delegates that find, you know, that they overlap and worry that the examiner, or what if they set a question where both traits are there and it could be either of them? The response to that is they won't. And then the delegate might say, but what if they do? And the response remains, they just won't. When this stuff comes up in the exam, when the behavioural finance traits stuff comes up in the exam, what you tend to find is the examiner gives you a small list of behavioural traits and says, take Stuart here, this is what Stuart says or what Stuart is doing, which behavioural trait is most likely to be the one that he's exhibiting, all right? And they'll give you a list out of this list. Not all of them, like just from memory, which one is it, but out of this list, say 5 behavioural traits, and they will not overlap. The examiner will deliberately write a question such that there's no sort of grey area, well, you could justify that one or it could be that one. They don't do it. Why don't they do it? Because they've got to mark it. And they don't want to mark that exam when actually the question's not a well-formed question. So you've got to trust that the examiner is going to set you a question with usually a small list in it, and you have to pick one of these traits out of a list and justify why it's the most relevant trait that your client is most likely exhibiting. Now we're just going to reinforce at this stage, and by the way, I'm going to reinforce another thing. The examiner is not out to catch you out. The CFA Institute is not there to catch you out. They're not there to write a question that cannot be answered and then snigger behind their hand at how no one can answer it. That's not, there might be, I think, you know, there might be other exams out there, I don't know, that do that, but it's not the CFA, okay? So stop fretting about what if they ask something that's unanswerable, and start focusing on the cases that are in front of you, and you'll start to see that the answers are usually relatively straightforward if you know your curriculum. Now, I'm just going to reinforce something else here. Do you remember this slide here is talking about cognitive versus emotional? Do you remember what we said? Just going to reinforce that cognitive is more easily removed through education. They call it moderated. Emotional stuff, which is hardwired, is more difficult to moderate or modify and may have to be accommodated into the asset allocation. Okay. Now what we're going to do for the rest of this module is we're going to look at the cognitive biases, these errors in processing information. Out of these cognitive biases, don't forget there's 9 cognitive errors in total. 5 of them, as you can see, are what are called belief perseverance biases. Okay, people sticking to their guns too much, people being stubborn, people not updating their view when maybe they should update their view. Or, so once again, faulty thought processes are leading us to not update a view or to come to the wrong conclusion when new information comes to light. All right. Central to this belief perseverance issue is the pain of observing information that does not fit with our current view of the world. It's called cognitive dissonance. It is actually described as a pain. This idea that there's information out there which we can't comprehend because it doesn't fit with our current view of the world. A defense mechanism to that pain is to maybe discount that information, maybe to go out to look for information that does agree with our view of the world, or maybe edit information in some way or over-represent some form of information in our mind. Make the world simpler than it actually is to fit our objectives. So that's what these 5 traits do. Once again, there's actually 9 cognitive errors, so there must be another 4. What are the other 4? The other 4 are information processing issues. So anchoring and adjustment, mental accounting, framing, and availability is all about how we process information, not so much that we're going to stick to our current opinion or we're going to try and avoid cognitive dissonance, but it's more that we're applying a process and the process itself is biased, okay? Or causes biases, or causes non-optimal behaviour from a traditional finance point of view. Right, so we're going to go through these. We're going to kind of name check them, make sure we know what they are, and make sure you know what to look out for in an exam question when a client is sitting in front of you and you might need to diagnose one of these biases. So conservatism. This is a belief. Don't forget the first 5 are belief perseverance. The final 4 are information processing. All right, so conservatism. Conservatism, this is belief perseverance. This is just the natural inclination that we have where we want to maintain our initial view to avoid the pain of having to update our view, to do the hard work of thinking and updating our view. What we're going to do is we're going to discount any new information that comes to light which contradicts with our view. So this is not something that's done overtly. This is something that's going on, if you like, below the radar. We're going to underweight or give less prominence new information that comes to light. So we've already got a view with conservatism. We've already got a view, and we underweight new information that contradicts with our existing view. So the classic application here that you need to keep an eye out for in the exam is to look for somebody that is maintaining a view. So there's a high, or there's an earnings forecast here, and the view is based on high profit margins, but for whatever reason, margins are declining, and John here is not changing their view. They're sticking to their guns. Okay, this is something that we all do, rather than engage in the pain and the hard work of processing new information and changing our view. Maybe we can discount the new information somehow. That's called conservatism. The consequences are we're slow to update our view, too slow to update the view that we currently hold. Maybe we hold securities longer than is rational. Maybe we believe in something longer than we should believe in it. The way to mitigate this, it's quite loose, not really a massive focus of the exam, to be honest, but it's quite loose. Be aware that conservatism is in place. Consider how you look at new information once you've formed a view. Does new information that come to light get as much prominence as the initial information that you use to pronounce the view? And if you really think that conservatism is a problem, then seek advice to help you overcome the conservatism problem. So, key point here, you're underweighting new info that conflicts with your existing view. Next up, confirmation. Confirmation is very similar, but it is different. Confirmation bias is the way that you seek out new information You are drawn towards things that back up your existing view and you're drawn away from things that might conflict from it. So confirmation is really seeking out the way you do research, the way that you screen for for updating your information. It's kind of screening out things that you don't want to hear, and you're really just coming back with things that confirm your initial view. Think echo chamber. Confirmation bias is where you deliver the way the people that you surround yourself with, the data sources that you use, the screening process that you use, and really all that comes back is evidence that evidence that your initial view is correct. All right, so this is a natural inclination that we have in order for us to feel psychologically better about the view that we currently hold. Key difference with conservatism. Conservatism is kind of ignoring information that is suggesting that our view is wrong. Confirmation bias is seeking out new information to justify a view that we already hold. Very similar, but different. So if John points towards, seeks out some sort of information that justifies his existing view. He didn't mention accelerating sales when he came to his high earnings conclusion originally. He was talking about margins, but now he's seeking out, well, look at that, there's an acceleration in sales, so I still think that their earnings are going to be just fine. That is looking for evidence which confirms a view that he already held, and that is potentially confirmation bias. All right, so your thought processes, your screenings are designed to find supporting information for something you already suspect or you already believe. It's a very powerful one, confirmation bias. The way we look for things might actually filter out part of the universe, so we only look for things that we subconsciously agree with. This can lead to us being, under-diversified. You could do research which, gives you conviction in a current holding, which just confirms your current view, which leads you to add to the stock. Which is dangerous if there really isn't any new information, or if you're only looking at part of the information that's available. This can lead you, if you believe in your employer, if you think your employer is a good place to work, all right, confirmation bias, if you believe in the company that you work for, all right, if you believe in the company that you work for, your company doing well could be confirmation bias that they're a good investment, could lead you to be overweight, to buy more stock in the company. Company does well, confirms your view, can lead you to be overweight in your employer's stock. Mitigation, to balance out the fact that you tend to seek out information that you that supports your existing view. The obvious thing to do is to consciously seek out contrary information. You do see that, don't you, with very sort of articulate politicians and debaters. They actually seek out the opposing view such that they can really test, and they enjoy it. And what they're really doing is, if you like, making sure they're not suffering from confirmation bias. At least that's one of the things that they're doing. So looking at different types of analysis, macro analysis to support a micro view, for example, taking different points of view on board, that's a way of mitigating confirmation bias. That's the second cognitive error, or cognitive bias, 2 of 9. The third one is representativeness. Representativeness, in layman's terms, is lazy stereotyping, really, or lazy labeling. So this is kind of like a heuristic problem where you label the world into sort of buckets, like growth versus value, large cap versus small cap, sophisticated investor versus retail. You kind of classify things, and then those labels cause you to make mistakes about how likely some sort of outcome is. Okay, that's what representativeness is. You are using labels to represent something that's more complicated than what the label says, and you get your probabilities wrong in the process. So representativeness, you've got some sort of classification that you've used in the past, some sort of label that you've applied to a situation, and you evaluate new evidence based on this label, and you make wrong conclusions. So there's 2 key reasons why representativeness can occur. All right, here's an example. John states that the company is a growth stock and therefore earnings will definitely increase. All right, so So definitely increase. Now, John's likely to be suffering from representativeness there because he's likely to be saying, well, you know, this stock is a growth stock, and therefore, and growth stocks have growing earnings. He's putting too much faith in that label, all right? He's really discounting the fact that there might be a bigger chance that this isn't a growth stock, or that, you know, there are some growth stocks whose earnings don't grow. He's kind of over-relying on this label. He's discounting the fact there's a lot of companies out there that aren't growth stocks, and this might be one of them, right? Or it might be a growth stock that doesn't actually have growing earnings. It's a misclassification, too much faith in that label that we use to simplify the world. So, you know, base rate neglect is the posh name for this, you know, too much faith in the label causing the mistake to be made. You know, John is neglecting the fact there's a lot of non-growth companies out there, and this company might be one of them. Needs to really assess, you know, how this stock was classified as a growth company to begin with, and whether that has changed. By the way, another form of representativeness is small sample or sample size neglect. This is where we rely on too few observations. So if you like, we're treating a small section of the past or a small data set, and we're projecting that to represent the whole world or the whole future. So John might use 2 years of data to come up with a forecast. That doesn't sound like a full market cycle to me. It doesn't sound like he's looked at the behaviour of the business or the security or whatever it is in all market conditions. So it looks to me like he's just using small sample size neglect or representativeness. In other words, he's assuming that 2 years of performance is going to just continue. All right, and that's over relying on you know, a small data size, a small set of data. So two different flavours of the same thing: over relying on a label or over relying on too few data points. Representativeness, I think, for me, you know, the base rate neglect one, it is quite ethereal. I'll give you another example of that, just so that we can, and a non-finance one, because let's not forget that these traits do come from psychology. They don't come from, they're not financial market things. They're psychological ideas, theories applied to financial market behaviour. So these have been around a lot longer than they've been in financial markets textbooks. And the classic case of representativeness would be to describe to somebody another person, you know, maybe describe John and say John loves books. He really loves books. He's quite quiet. He loves quiet spaces. He loves books. He loves reading. He's a little bit of an introvert. You know, he's quite sort of geek chic, you know, sort of thing. And what I'm describing there, I'm giving you all the traits of a librarian, right? You know, loves hanging around in quiet places, reading books. Giving you all the traits of a librarian. If I say to you, what's the probability of John being a librarian? It's likely that you'll say, oh, he's definitely a librarian. And you'll say, why? Well, because you just described all the traits of a librarian. So John's almost definitely a librarian. And this is base rate neglect, because you've ignored the fact that there's a lot of people out there that exhibit the traits of librarians. I don't want to, well, it's lazy stereotyping, isn't it? You know, exhibits the traits of a stereotypic librarian, but they're not actually librarians. You're ignoring that most people that exhibit these traits actually don't work in a library. There's loads of people into books, introverts, that work in, John works in finance. They work in lots of different areas, and it's base rate neglect. Most, you know, meek, sort of introverted, sort of studious, book reading, bookworm type people actually aren't librarians, whereas most librarians are that. It's not the other way around, and that's base rate neglect. All right, let's move on. How do we deal with representativeness, or what are the consequences? Well, once again, think lazy stereotyping. You're taking a little bit of data and you're saying, yes, that is representative of the whole data set, or that label is giving me all this information about this stock or this investment, or those last 2 years are going to represent the next 10 years. It's really too much emphasis on inadequate initial data and lazy labeling. All right. If you reclassify things too quickly, that might be representativeness, throwing things into buckets very quickly. and making decisions based on simple rules of thumb, based on labels, rather than an intimate analysis of the investment. That might very well be representativeness. Mitigation, make sure you collect enough data, do proper statistical and probability analysis, all right, and follow a long-term strategic asset allocation rather than getting distracted towards shorter-term trends. Okay, that's representativeness. Moving on, the fourth cognitive bias is the illusion of control. It's the illusion of control. Now, we're not saying these investors don't have any control at all, but they think they've got more control than they actually have. This is the key thing with these biases, is that it's not that these things don't exist at all. It's that there is too much of it going on. We think there's too much control. We've got too much control over our fortunes, over the fortunes of our investment. The classic application here is, this is where superstition comes in. Look at sports players, the way they have a routine. If they do things in a certain order, then they get a good result. It's just the illusion of control. Look at people that pick their own lottery numbers. That doesn't actually boost their chances. That's the illusion of control. And when it comes to investment, a classic application of this is actually, doing a lot of work. Doing more work gives you the illusion that you're in control of the outcome of you're kind of reducing risk by doing. Of course, if you don't do proper risk analysis, then yes, you're negligent. But once you've done proper risk analysis, just repeating what you're doing a lot doesn't give you any more control over the outcome. So, this is an issue with the illusion of control. Doing lots of work, thinking that the more that you do, the more work that you do, the more control you have over the outcome. The other thing here is, of course, you might think that you can control your employer's stock more than you actually can. So John's got a client here that's an executive, maybe junior executive. I was going to say maybe middle management or not like CEO, something like that. And they're a junior executive, middle management. They insist on holding a large block of their employer because they think if they work hard, that will lead to good performance of the stock. That is a classic example of illusion of control. Now, this illusion of control might give you too much confidence and lead you to be under-diversified. The illusion of control might lead you to trade too frequently if you think that you've got control of your investments without doing maybe an adequate amount of work, and you're relying on illusions of control like this executive here is here. Mitigation, do proper analysis, as we've already said, and really give good thought to what could go wrong. Keep records of past results so you can see maybe where you thought you were in control of a situation and maybe you weren't. Now, the fifth cognitive trait here is hindsight bias. Hindsight bias is where you look back on things and you see them differently to how you saw them at the time. So you're editing information. In order to avoid the pain of being wrong, the cognitive dissonance of remembering things that suggest the world is different to how you see it, hindsight bias might lead you to edit out of history things that you got wrong. So hindsight bias is selective memory of past events, such that you can think about the past in a less painful way. Classic application of hindsight bias. Sally recommends a new stock to her boss. Sally recommended a new stock that her boss rejected. Then when the stock price collapses after the fact, Sally claims she predicted it. That's aggressive hindsight editing, isn't it? She's just saying she thought she said the opposite. That's just straight up lying. I think hindsight bias is a little bit more subtle than this. Hindsight bias is where you forget just how unlikely something was prior to it happening. So the classic example here is, some of the political kind of seismic shifts that we've seen here in the UK. We're still going through, the Brexit process, and that was deemed to be very, very unlikely. Now it's part of, can't get away from it. It's obviously happening and stuff, but prior to it happening, it was, if you like, ex ante. Prior to it happening, no one thought it was going to happen, and then it did. And there's been quite a lot of that going on of late. And so hindsight bias you edit out how unlikely something was before it happened. It's really quite powerful. If I tossed a coin here and it said heads, you would think, well, that coin was going to say heads. You'd forget the fact that it was 50-50. In fact, there'll be people out there now saying, but it did say heads. And that's it. Well, yeah, but it was 50-50. And then people will say, but it did say heads. And you're kind of editing the world. No, it was random. It was random. And, that's the issue. The issue is that you kind of forget how hard to predict things are. You might overestimate your ability to predict things. You might take too much risk. You might find that clients are overcritical of managers being able to predict things that have happened in the past. Why didn't you predict Brexit? Why didn't you predict popularism? Why didn't you predict, all these things that have happened? So mitigation here, keep records of what you thought prior to events. Acknowledge past mistakes and don't confuse results with simply, market movements. Don't think because you bought something and it went up, that was your skill, but you bought something, it went down and you kind of edit it out of your history. Don't do that. Try to resist doing that, because that's the classic application of the bias. All right, so those ones that we've seen, those cognitive traits that we've seen here, these are belief perseverance biases. The remaining 4 cognitive biases are actually information processing issues. So we've got here anchoring and adjustment. Anchoring is where you give too much weight, you're kind of stuck on an initial forecast, an initial anchor point or a starting point, usually what where something currently is or what you've recently appraised a value to be. That's a classic example. You give too much weight to that starting point for analysis, and you don't give enough weight to any sort of subsequent changes that need to happen. Oh, the classic application here is analysts' forecasts from a numerical point of view. This is the way the curriculum presents this. This is to do with a number. You're anchored to a number. There'll be people out there saying, what's the difference between this and conservatism? Conservatism is a view. Anchoring is a number. They're very, very similar, but anchoring and adjustment is where you're doing some sort of numerical forecasting or estimation, and new information comes to light, or you need to incorporate new information outside of the anchor that you started with, your starting point, and you fail to give that new information adequate weight. And so you don't update your forecast as much as maybe you should have. Take John again. John seems to be exhibiting a lot of behavioural biases, doesn't he? John initially estimated EPS of $3, and as company fundamentals have deteriorated, he then adjusts this down by 5%. Now, anchoring and adjustment says that is probably not enough. That's probably not enough. If he started with a blank piece of paper and did a fundamental analysis without that 3 in his mind, without being anchored to that $3, if he did a blank piece of paper and just did it all again from scratch, he would be marking it down by more than 5%. But there's nothing to mark down. The problem here is that John's starting at 3 and then marking that down, and that's likely to be overweighting the 3 and not giving enough weight to things that suggest it is less than 3. This is, once again, is not just a financial trait. This has its roots in psychology. We're always anchored to the most recent number that we've heard. We are. It's a really powerful thing, even if it's irrelevant. You can see, I wouldn't waste too much time doing recreational sort of studying, but you can see plenty of applications in psychology where people are just told a large number and then they're asked a question. They tend to give bigger numbers as an answer versus a group that were told smaller numbers. It's a really powerful thing. So insufficient adjustments to analyst estimates. The mitigation might be, thinking about whether your reasonable analysis should really have that starting point. Maybe we should build another analysis from scratch, or maybe ask for an independent analysis from a new source rather than an existing source that already came to some sort of numerical forecast. Right? And obviously updating forecasts with new information correctly is the antidote to anchoring and adjustment. Now, number 7 here, we've seen it before. In the last module, we spoke about mental accounting when we're talking about behavioural portfolio theory. That trait which explains how people build up portfolios in layers, and they're very safe with the component that's to meet really essential goals, and they take more risk once they've essentially met the allocation that they need to meet these really core goals, they take more risk as they build their portfolio up. More generally, mental accounting is where we segregate our portfolio up into parts, and we treat each part differently. So, we've already seen an application of this. I've just mentioned it in the previous module, behavioural portfolio theory. One part of our portfolio is cash, safe, right? We need to pay the bills with that, right? And then once we've covered that, we'll take a bit more risk with this, where we'll earn market returns. Once we've covered that, we're happy with that, we'll take lots of risk with this to try and get richer. These kind of divides that I'm making here, this is carving up our portfolio and treating different parts of the portfolio in a different way, with different objectives, okay, from a risk and return perspective. So money is treated differently. What we do is we segment our portfolio into different accounts, and we treat each different account differently. All right, we segment our portfolio into different parts, and we treat each different part in a different way. Okay, and the way we categorize each different part is integral as to why we give it different objectives. Like, for example, this part of the portfolio is to pay the bills, so be very safe with that. This part of the portfolio is to double up and get richer, so let's put that into the lotto, something like that. Okay, so that's the sort of thing we saw in the previous reading. You can see this client doing it here, holding bonds to meet income needs, holding stocks to meet retirement needs. They're not taking a holistic approach to their portfolio. They're not taking a total return approach to their portfolio. They're segmenting it up. Income is coming from over here. Capital gain is coming from over here. And that's likely to lead to an inefficient portfolio from a traditional finance point of view. It ignores the correlation between layers, just like we said in behavioural portfolio theory in the last reading, and it might lead to a lower return per unit of risk, an inefficient portfolio. Mental accounting is so strong, what you'll see later on in level 3 is that we actually say, do you know what, we're just going to incorporate it into our investment advice. So you will see mental accounting coming in. We'll use it to talk to clients that have concentrated positions to try and convince them to diversify. We're going to use it when we're doing asset allocation based on goals, because that's how people think. All right, it's there a lot. You've got to think a lot of these traits. It's not so much saying, that's bad. We either need to remove it or adjust for it. Sometimes we can incorporate it into the process and communicate with our clients better because we are thinking in their terms. Right? It makes it more easier to meet their goals as well, more likely to meet their goals. Now the 8th trait here, information processing problem, cognitive error, is framing. Once again, we met this actually when we're talking about the consumptions and savings model in the previous module. Framing is where we make a different decision based on how the same information is presented to us. All right? Decisions are affected by how a question or information is framed. Take an old friend, for example, value at risk. Value at risk, or an even more simple one. Why not? A more simple one. You'll find firms saying that their products are 99% fat-free. All right? They won't say it's 1% fat. Okay? They won't say that. Not unless, of course, they can compare it to another product, which is like 10% fat. So really, most providers will say how much is good rather than how much is bad. I was going to give you the example of value at risk as well. Your clients might say, hey, what's the risk of the portfolio? And you might say, well, there's only a 5% chance that I lose $1 million or more over a particular time frame. And they say, what are you doing? You're trying to lose money? 5% chance you'll lose $1 million or more? That's of course. And you go, oh, sorry, no, what I meant was there's a 95% chance that I won't lose $1 million. Now, it's the same information, but the way you framed it makes it sound better. All right? And, that's classic framing. So what about John here? John presents portfolios ranked by standard deviation of return instead of projected value. Now, key thing is that creates a different impression and different decisions are made. So to fill in that example there, we should say that, John presents portfolios in a certain way based on return and the client says, I want that one. And then John presents the portfolios with maybe ordered in a different way and the client goes, oh no, in that case I prefer the other one. And it's the way that we presented the information which changes the decision. Do you remember the isolation effect when we were looking at prospect theory? Do you remember how people changed their decision for a game, A versus B, C versus D, Do you remember that? That was in a previous module, in the previous section. That was framing as well, wasn't it? And do you remember, that's loss aversion. Loss aversion's got framing embedded in it because we frame where we are on a decision in terms of gains and losses. So yeah, there might be, due to framing, we might have excessive focus on the short term, over trading based on key pieces of information and the way it's framed, suboptimal asset allocation. You know, a lot of these things are really just saying that the portfolio is unlikely to be the optimal portfolio based on an objective assessment of facts. Mitigation, you know, be very careful as to how information is framed, how questions are asked, how information is presented to clients. And think about what it looks like when you present information to clients. Okay, the final cognitive trait here is availability. Availability is linked to how easy it is to access information. And the idea is that we access information that is easiest for us to access. And you might say, so what? And the answer to that is, well, we might think that's the world when it isn't. And so we might get our probabilities wrong. So for example, there's different flavours of availability. There's different things that cause us to find the recall of information or the access to information easy. The first one is retrievability. You know, you might go on your Bloomberg terminal, you might, other, you know, terminals are available, or you might look into, you might go on the internet and do a quick search. The one that comes up first, you know, the first one that you find, the one that's most heavily marketed, or the one that's most famous, you know, that's the one that's easiest to recall, and that's the one you assume is most relevant. You assume it's a bigger part of the universe than maybe it actually is. So an example here would be a client that subscribes to a growth stock newsletter. They might think that growth stocks make up a bigger part of the overall world than they actually do. All right, so you know, they will certainly be able to access in their mind more growth stocks than value stocks, and they might think that they're more frequently, you know, they're simply because they're easier to retrieve. They might think that they're more relevant to analysis. Another cause of availability is categorization. It might be the case that an investor is more familiar with a certain type of investment, so simply because of what they do. So, and they might think that the available data there is more representative of the overall universe than it actually is. So this client that can recall more growth stocks, right, than value stocks because they subscribe to a growth stock newsletter, they might think, now don't forget growth stocks tend to have high multiples, they might think that there's more high PE stocks out there due to the fact that they're more familiar with that category. They might think there's more high PE stocks out there than low PE stocks. They might think there's more high PE stocks out there than there actually are. Another example of categorization might be that you're just familiar with a particular category. So someone in the UK might think that there's more soccer players than American baseball players, but that might be simply because you know, it's a category that I'm more familiar with. And all of this revolves around the investor's, what data the investor has been exposed to in the past, and them kind of extrapolating. Because of its ease of recall, they're kind of just assuming that it's more relevant than it actually is. They're giving it a higher weighting than they should. This is compounded by having a narrow range of experience. So a very narrow range of experience could lead you to think that something that you do or something that you're familiar with is more of the norm than it actually is. So a classic example might be a CFA candidate familiar with US tax law. They might start writing about US tax law in the exam when actually US tax law is not what the exam is about. The exam is about sort of general ideas about taxation, and they're not writing something that is relevant. There's some good advice there with regards to exam technique as well. And the other thing that we tend to do is we tend to assume, you know, it's all linked together this, but we tend to over-remember things that are like us, all right? Things that resonate like us. People like us, we tend to remember them, or things that are familiar to us, we tend to remember them more than things that are unfamiliar to us. In other words, if I go to a party and I meet somebody that's got some sort of experience with CFA or some sort of experience in financial markets, I'm more likely to remember them and think that they're like me in all sorts of ways, all right? And kind of, once again, they're over-relevant in my mind, easier to access that information, easier to remember what they do than it is what other people did, what the medical person did and so on, that actually didn't resonate with me at all. So, in the exam, availability, they have drilled down into these lower kind of strands of availability. I think, you've got to keep an eye out for it. Once again, when you look at the case in front of you, there's some very specific things which they're not hints, they're the answer. They're telling you what the answer is in the case. You need to lift them out. So if somebody's been with the same investment firm all of their life and they're wondering if they do a good job, guess what? This is going to come into play. They've been with the same manager all of their life. They've got a relatively narrow range of experience with regards to different types of managers. The manager that they're currently with, they're more likely to think that that manager is, relevant to them, is a good fund manager and is doing a good job than if they had a more broader range of experience of different types of fund managers. Yeah. All right. So yes, decisions based on marketing or advertising, familiarity, could lead you to be too concentrated in sticking with what you know, thinking that represents the world, when actually the world isn't quite as much like you or your range of experiences or the categories that you're familiar as you might think. The world's actually a bit more different than what you think. Okay, well look, that concludes Module 1 of Reading 8. Your task is to make sure you understand the 9 cognitive biases. In the next module, we'll look at the 6 emotional biases. But for now, it's a very important module. I'll just reinforce that. The examiner often gives you some type of behaviour and asks you which cognitive or emotional biases, which are coming up next, are in play. So make sure you can do that.